Success is not the key to happiness. Happiness is the key to success. If you love what you are doing, you will be successful. Good afternoon, everyone. It's a pleasure to be here. Glad to be here as a part of the community across the globe. And thanks to Money 2.2 organizers. Thanks to Money 2.2 organizers who provide us the opportunity to learn and gain experiences and knowledge. And our topic for panel discussion is the role of private capital navigating the COVID-19 crisis and fueling post-pandemic recovery. So I would love to call my co-panelists here on stage. We have Alok, Amarpreet, Pradeep and Willie. Experience of advising multinational and family-owned business in the region.
Thank you, Charlie. Good afternoon, everyone. It's been interesting days so far. So a quick introduction, a bit more about myself. I've been in the region for good 29 years. So like I was chatting with some of you during the coffee break, it's been a very patient journey. Especially given the fact that the whole region has been transforming. So my experience so far has been through the consulting field. I was partner with Ernst & Young Dubai, and I was leading the tax and regulatory practice until last year when COVID hit me, and we said, all right, why don't I start something of my own, and I started my own consulting practice last year. And my area of focus has been primarily on the side of how I can sort of engage and help international businesses who are willing to set up shops here in the region, helping them with all the cross-border tax structuring, business structuring, and also from this side, outbound, where lots of family-owned businesses are investing outside of the region. And my forte is to sort of help them with starting from the development of family constitution, governance, platform, etc. for the families, to also help them set up structures outside of the region, internationally. So that's what I've done so far, and happy to engage with you.
Thank you so much. Next is Amarpreet. Amarpreet Singh has 20 years of experience in supply chain operations, business process, in FMCG, retail, health tech and fintech.
Thank you everybody. So just a bit about me. I come purely from process and supply chain, business process background. I was heading supply chain for Walmart in India. That's when I decided that okay, no longer the corporate industry, so I decided to do my own startups. I have been working with health tech. I've been working with health tech, ed tech, as well as fintech segments. Currently, I'm founder of a company called Cashware, where we do a lot of innovative stuff. We link all your credit card, debit cards, cryptocurrencies, wallets into one physical card. And it's going to be currently physical card, tomorrow it can be a keychain, it can be a mobile phone, it can be any other way of instrument, it can be your retina or anything. So we are here to link all the money together, and because of these tech-first businesses, I have seen how COVID has impacted the innovators like us, how people who are very, very curious in backing us up, and how the shape and all of that.
Thank you. Okay. Next is Walid. Walid is an entrepreneur started in 1995 when he was advised by a colleague to check the internet. Right? What an interesting story, right? He then co-founded City Cyber Cafe in Pune, India, 1996. In 2021, he launched the pre-seed venture studio fund in Silicon Valley. Over to you.
Great, she's been saying. It all started in 1995. I was in Pune, in German bakery. And a colleague of mine told me there's something called the internet, you need to check it. And I've always believed, through Web 1, Web 2 and Web 3 right now, how valuable this technology can bring to our life. I've started working in e-government in UAE in the early 2000, basically in 2000. And I started venturing out in 2006, establishing a couple of ventures. My latest group is a group called Inbound LLC, which is providing mobility and logistic technology to government, to semi-government and other NMC companies over here. I've launched in 2018, I've launched a venture studio in logistic and mobility in Estonia, and we launched basically a seed sort of venture studio in 2021 in Silicon Valley. Thank you.
Thank you. Okay. Pradeep. Pradeep is a seasoned business manager with experience in B2B, SaaS-based technology, product developments in fintech, investment tech, and market research space. Over to you.
Thanks, Shalu. Good evening, everyone. My name is Pradeep, as Shalu mentioned. I am an AVP for this India-based company called Traction Technologies. It specializes in developing a SaaS-based product for connecting private market investors to the founders of companies which are seeking fundings and vice versa. It also provides a suite of products for all private market investors to manage their portfolio, manage the CRM, talk to the founders, and manage their day-to-day work. I am here today to kind of talk about how COVID has impacted the startup ecosystem in India and also globally. And I have some data that has been provided to me by my wonderful company which I work for, Traction Technologies, which clearly tells us that how things have changed pre-COVID and post-COVID. So looking forward to talk about that. Thank you.
Thank you. Okay. Myself, I am a CA Shalu Arora. I am a qualified chartered accountant and company secretary and a forensic auditor as well. I have a diversified post-qualification experience of around 8 years. In my initial career, I worked as a practicing chartered accountant where I used to deal with audits, due diligence and consultancy services. And currently, I am working with Sirca Paints India Limited as the Chief Financial Officer. Sirca Paint is one of the top 1,000 listed companies in India. My role has the primary responsibility for planning, implementing, managing and running all financial activities, establishing and developing a relationship with senior management, external partners and stakeholders. So without wasting much time, let's start with the discussion. Okay. We can all agree that COVID-19 has resulted in a global health and economic crisis on a scale unlike we have experienced in our lifetimes. Against this gloomy backdrop, we expect private equity firms and their investors to play a key role in long-term economic development and recovery. The sector is showing signs of optimism about its ability to transform the challenges created by the pandemic into opportunities as new startups are coming up and some district sectors are also trying to gain momentum. Yes, Alok, what do you say about that?
Sure. No, I think we can all. Yeah, can you hear me? Yeah. All right. So we can all agree that it's been an interesting journey, especially when we talk about startups in the fintech industry post COVID. Where some of the unicorns and startups are struggling to find the right investors, and so I, as an advisor, see it on a day-to-day basis when we're consulting with such players, where we've got a beautiful idea on one side, and there is VC sitting on the other side, or this private equity investor sitting on the other side. But how do you make sure that they are able to sort of engage? And I'm only going to say there are a couple of challenges that we sort of experienced in this, from my perspective. The biggest of all has been, I think, the regulatory framework. When we're talking about the regulatory framework, I think, especially for the fintech and insurtech industry, I think we can all agree, we are still in that evolution phase, and where we haven't got the right kind of regulatory framework across all countries. Some of the countries are more advanced than the others. We've seen US probably a few steps ahead and India a few steps ahead. And when we talk about this region in particular, where central banks are still sort of trying to develop the regulatory framework, or when we're talking about capital market authorities trying to intervene and see what part of this the setup would they be involved in. So that is one of the biggest challenges that we talk about having the investment. And I think the second challenge in particular is around getting the right valuations. It's a nightmare, as I call it, for a professional like myself. And when we're talking about a beautiful idea on the other side, but how do you value that idea? What kind of valuation that you can put in? And because any investor, as typically one would like, the question is around, are you you going to be following an asset-based valuation, or are you going to follow a return on investment, or multiple valuations, or to your investment? So how do you actually value that technology and the startup, and then get the investor to invest in? So I think these are the two challenges that I have experienced, and obviously we are all going through this journey, and we're seeing a lot of evolution already happening in this space.
Yes, Pradeep, what's your say?
Coming from what I have witnessed during these times, I've realized that there was a drastic change in the preferences of people in the market. Many business verticals actually struggled and faced a lot of challenges, and there were many business ventures and entrepreneurs who saw opportunity in these times and actually cashed on it. What I realized that traditional businesses who we see day to day, they struggled a lot, who had a lot of on-field work, or they are providing a hardware product to their customers. But now the cinemas were empty. There was a reduction of in fact, the cinemas were completely banned for a while due to COVID, and there were no sales of tickets. But at the same time, toilet papers were running out of these hypermarkets. So the startup ecosystem in India is kind of in its own nascent stage right now, but still many people who had these entrepreneurial skills, they saw an opportunity here, and thinking from the first principles and finding the problems that can be solved. There were a number of ventures that got created. So if you have to see the number, there were around 7.8K companies that were founded in 2009. But post-COVID, till now, more than 16,000 companies have been registered officially as startups across the world. So that itself shows that how many people actually worked on their ideas and saw opportunities in these times. So for me, from a business point of view, what I can say is that people who had the drive and they were able to solve problems, very necessity-driven problems, problems that were addressing the essentials of the people in these times. They were the ones who grew drastically, and a large number of unicorns and decathlons were created. Many big companies went public during these times. And a major driving factor for this was the private capital that we have in the market. Many people who were not into investing earlier, they were very confined with their investment thesis, have also started diversifying now because they also saw opportunities in sectors where they never thought that there could be a product. And I think that is the thing that with humans, whenever there is a calamity, they also somehow try to find a solution and how to sell it as well for the betterment of the people. So yeah, I would say that keeping aside all the downsides of this worldwide spread of the virus, there are a lot of good things that came into existence for the benefit of the people, which will drastically affect the lifestyles of the people and lives of people at scale. So yeah, that's about it.
Thank you. Amarpreet, can you please elaborate the impact of COVID on startups, especially fintechs?
See, in India we do a lot of fasting, and you know what is the science behind fasting? That your weaker tissues actually die. It makes you healthy. Now, a saying has been, whether it was not a desired fasting, it came forcibly. The COVID has actually taken away a lot of businesses which are weaker in nature. The transition has happened with the tech-first businesses much faster pace than it should have, than it would have been. Not saying that there are many businesses who actually was in their infancy. So let's say if there is an infant and they need to fast because of lack of food, what will happen? Right? So there are a lot of businesses which were very beautiful ideas, doing very well, but they were in their infancy and then could not survive. Now, fortunately, the three sectors that I've been into, EdTech, HealthTech, and FinTech, all three got a boost because all of three were tech-first businesses. All of three got a boost because of the COVID. However, we have seen on the other side, lot of such businesses which were not on these, and not even necessarily, let's say all the health tech got the boom. Even there were a lot of health tech companies, one of them I know very closely, They were about to get a funding when the COVID happened, and that funding got dissolved. They did not go with the final round, and they had to cut down massively to just sustain. Now, many of the people who could take the right tough decisions could sustain and are again there, but there are many who could not take those decisions and are not there. So, one side is the type of industry, the second is the type of decisions, how you cope up with them, made what happened with these startups. Some on the positive side and many on the negative.
Thank you. Waleed, there are many non-attractive sectors in economy. So, the pandemic hit them so hard. So, what do you say? What's the role of venture capitalist?
I think one of the main basics of innovation, 10 years ago we used to do innovation workshop and we generate ideas. So the approach for generating ideas is that we ask every table like this, is that what are the most important things in your life? What are the top 3 most important things in your life? Some people they will say money, some people they will say a house or transport or whatever. So we tell them, okay, what if tomorrow you wake up and you find money is not there? So what sort of challenges will happen? So when they start solving those challenges through technological innovation, then the value of money is no longer there. Now, during the pandemic, we find out during the lockdown, there was so many basics that they were very important in our life. We could not practice them anymore. So many challenges has arisen from there. Earlier, the tech startup, it was all about premium market. It's about convenience. It's about getting things better and all. But during the pandemic and during the lockdown, it has really touched the basic need, the must-have stuff like getting food from the grocery or getting your car to the service or maybe getting some of the medicine delivered to your house. So that's why there's so many so-called non-attractive sectors which they were reluctant to have any sort of digital transformation. Those attractive sectors, it became a do or die for them to do a high level of digital transformation. That's why we see the pressure on logistic and on supply chain has been very, very high. Earlier, you used to get a container shipped from China to Dubai for $2,000. Today, it could cost you $12,000, sometimes $20,000. There's a lot of backlog, there's a lot of constraint, there's a lot of stuff. That's why we see there's an opportunity for startup founders to disrupt so many non-attractive sectors, and this will also put a pressure on the need for the pre-seed and seed level funding. This is what it's all about, because like we're having another level of baby boomer time, in which so many startups need to come up to sort out those challenges, and the main funding gap right now into pre-seed and seed level. That's why we see the emergence of a lot of micro VC, a lot of American VCs, and we see companies like Sequoia. They have changed their business model into running several micro VCs instead of running as a whole, multi-billion dollar fund.
Thank you. Alok, my next question is from you. Nowadays, people are very much interested in startups, but still they face challenges while getting funding. So, what your say on this?
Yeah, absolutely right. I think aside from what I do, I also am very active with the startup initiative in Kuwait and in the UAE, etc. And therefore engage with a number of players who are presenting their profiles, presenting their credentials in terms of what they are developing on a day-to-day basis, and then also trying to engage with potential investors. I think, like I said, that I offered 2 challenges in my introductory comment, but then I think if I were to sort of pick up from one of them, I think the biggest issue is around the valuation, when we talk about valuation, and there's a lot of deals already happening. I mean, if you look at the deal size, which was probably about 4 billion back in 2014 to now, we're talking about 80 billion in the private equity space in the last half of 2021. That itself speaks volumes of what is happening. But then the challenges around how does one justify and present to landlords to what kind of return on investment you will get on that thing, the kind of what kind of collateral or security you can provide to the investor, where if it is and the kind of what kind of time frame and the horizon that you will present to the investor, and in terms of the future projections, etc. There's so much. It's all driven by technology. There's no hardware as such, or there's no product that you're selling. You are actually selling an idea and the concept and the platform and around it. And so the basic valuation of that and to present that idea and to be able to sell that to an investor is always a challenge.
Okay. Just a follow-up question. Sometimes there is a tech guy behind the idea, so they don't understand financial terms very well. So can you please clear the air by?
It's an excellent point, and I think that is one space where everybody sort of struggles. Almost every startup that I've worked with struggles because they don't even have an idea on how to build projections and business plans and do the feasibility study and get through the due diligence process of with the potential investor, and hence because rightly so, I mean they are technical at the end of the day and don't really understand business and finance and don't really understand how to project themselves from a financial projections perspective and so yeah, and helping them through that journey is obviously been very interesting and
It's again an opportunity for finance people. Right. Okay. Pradeep, my next question is for you. How did private capital help in post-pandemic recovery, and in which particular sector?
Right. As I was saying earlier, that private capital has been a great driving factor in solving many of these problems during times of COVID. I have shortlisted few industries where we saw a lot of activities. Now, these industries are not those essential service providers such as internet, electricity, because they have always been in existence. They have always addressed as per the necessity of the crowd. They just had to meet with the increased demand during these times. But there were certain sectors of technology and also certain sectors of traditional businesses where traditional businesses were running out of options because of COVID. And they were forced to collaborate with these tech-based companies to run their businesses. So here's a list of few sectors which I have shortlisted, which we believe are the most contributing industries during those times. Also, they were the ones who saw the maximum growth. So there were sectors like health solutions providers, where telemedicine, online health information, personal protective equipment, symptom checkers, remote monitoring solutions, disinfection robots, and online fitness. Many people got into online fitness because they were not able to go to gyms during these times, and even companies had to roll out certain health programs and fitness programs for their employees so that they can collaborate online and start doing yoga or maybe aerobics together while sharing the screens. So the second category is online gaming platforms, online e-commerce platforms like online grocery stores, meal delivery services, personal hygiene. Fourth being entertainment platforms like Netflix, OTT streaming platforms, gaming platforms, events, online hobby classes. Many people had these additional time now to fill in. They saved by not commuting to work every day, and they started taking up new hobbies to keep engaged themselves and their family members. And of course, needless to mention, remote working tools and online education. So these are the industries and sectors which actually sum up to a total private capital funding of $273 billion as of today. And one interesting fact to know is that I have created a comparative analysis of pre-COVID, which means 2019, and post-COVID, means 2020 till this date. How much activity we have seen in this industry, these industries. So if we talk about it in 2019, as I mentioned earlier, there were 7.5K companies founded, but we saw a twofold increase of almost 16K companies that were founded post-COVID. And it is not that these companies or these opportunities were arising only in developing nations. In fact, the major frontrunners were developed nations who were creating these solutions to help the global citizens of the world. US leading the race, followed by India and then Europe. Let's move on to the exits part of it, which will give us a clear picture of how many companies actually grew their business, got acquired. So there were 167 companies in 2019, but that number increased threefolds to almost 600 plus companies which got acquired after COVID. I mean, from a point of view when we think that, okay, things are not working, our businesses are going down, these are the numbers which actually contradict that belief and give us a clear picture that there were industries and companies who were cashing on and helping us out through these difficult times. Speaking of exits, there were 19 IPOs in 2019 from these industries that I have invested, but post-COVID there were 60, again a threefold increase. And as we are discussing about the role of private capital in this entire scenario, these industries actually had funding of around 25 billion in 2019, but post-COVID the number increased fourfolds to $119 billion. This clearly gives us a picture that there was a great activity among the investors, which also encouraged new people to become investors and already existing institutional investors to diversify their portfolio. Invest in tech companies, invest in smaller companies who have a reliable background and who can guarantee that these solutions are going to scale at length. If we look at these investors, right, the top 5 most active investors who are investing in these industries are Y Combinator, Techstar, 500 Global, Sequoia Capital, as you mentioned. These are the companies who are known for funding growth stage companies. But the interesting part is that during these times, not only they were giving acceleration and incubation, they were also giving the pre-seed rounds, seed rounds, early stage funding. They were helping these enthusiastic entrepreneurs to set up a solution ASAP and roll it out to the market. And that gives us a clear picture that how crucial private capital is, specifically in these times of distress. So, I mean, the whole point is that whatever be the scenario, this pandemic, I think not even just the recovery, in fact, throughout the sustenance during these times, private capital has helped a lot of companies to deliver a lot of useful products to people. And I mean, that's the end of the day, I think, the biggest ROI here. Right, that's it.
Thank you. Amar, tell me one thing. There are so many small retailers which had to shut down their business due to COVID. So what's your say about that?
Retailers and the MSME sector has been hit the hardest. While we say that tech-first businesses have gained, it's definitely at the expense of these old traditional businesses. And one thing that we say is that slowly what will happen? Assume there would not have been any COVID. Still things are getting so organized, let's say a few years from now, let's say a few decades from now, anyway all the traditional systems would have become a part of the organized businesses. For example, let's say all the car drivers, taxi drivers had become part of Uber, etc. Similarly, all the hotel players have become part of aggregated chain. So similarly, what I see is a lot of these unorganized businesses would have become part of organized business. Like there have been a scale up on the tech side, and the digital growth has become faster because of COVID. Similarly, because many of these businesses who are struggling, especially on the retail side, because of COVID, will start becoming either a supplier or a franchisee or a part of these organized players so that they can survive. Which means that shifts focus that where the middlemen, rather than these middlemen, the focus will shift to the production. Rather than now being more retailers, there have to be more producers because there are enough and more avenues to sell products. which means we need people who can put up more factories, more industries. But sadder to say why things are getting expensive, why inflation is there, because these industries have been hit the hardest. Even though we as a tech first company can distribute those products better, but these factories have been hit the hardest. These are the people who I think in the private capital needs much more support. And that's where I think the private capital, rather than evaluating, while we talk about valuations, evaluating them on just the performance, they need to evaluate them on their basic valuation, right? When we talk about rather than supply chain, the value chain theory, we need to talk about what the value they are adding. And these are the people who, the private capital, rather than on the debt side, the unfortunate part is on the digital growth basis, the startups do get funding from the offering equity, but a lot of this MSC segment, they only get a debt capital. How can the people with money, because again the money is shifted, the divide of money has only got skewed, how these people can put much more money and are able to take bets in terms of equity in these manufacturing sectors, because that's where the real consumption is going to come from.
Thank you so much. Waleed, my next question is for you. Okay, in this COVID itself, some people are still hit hard, but they are still gathering courage to start their own businesses. So what advices would you like to give to startups?
Well, I think, during the pandemic, especially the lockdown, there have been a lot of stimulus plan that has been offered from the government. But again, there would be a moment of the truth that those stimulus plan will no longer be supplied. So most of those industries, what we advise them is that there's a lot of private capital available today, and especially after the interest rate for many countries has been brought very minimum to the zero. That makes the VC investment as an asset class more lucrative to many investors who have not been looking at this segment. So the money is there. They do have to focus on solving real challenges and trying, as Amar said, for example, you've got a lot of retail, you've got a lot of small restaurants that has been hit hard. But now we see a lot of cloud kitchen, we see a lot of dark stores that if they could utilize this model with a bit of a shift from their own brick and mortar model, moving towards more production model, that would really enhance their gross margin and eventually give them a more survival status. In terms of what they could do from a VC or an investor perspective, most of the founders are looking right now for product to market fit. There is one more important element that we have seen during COVID is that founder to market fit tends to be more important than product to market fit, because the resilience, that some of the founders show during unpredictable time. Because right now, if you have some, big changes, every 2 and 3 years. Now you could see those big changes in a month's time. So you require the founders to be more resilient in terms of focusing to founder market fit. Whenever we mentor any of the startup founders, we tell them you have to look down the line for the next 10 years. If you do not feel you are excited enough to do this 10 years from now, then you have to find something else, because you need like 2-3 years to find the scalability and repeatability, and then from there you need to start scale and then repeat for another 3 to 4 years. That's 6 years, and then you start planning for exit, hopefully exiting by year 8 or 9, below the normal fund period of 10 years. So these are some of the advices that we give to the founders. Another main advice is that to look at their niche and their challenges rather than looking at the product. Because the product today is there, tomorrow it is not there. Today you have a restaurant and you have waiters and stuff like that. No, tomorrow you're doing a cloud kitchen. So the product changed, but the customer or your niche challenges are still there. So you will be able, by focusing on the customer and the niche, you'll be able to disrupt your own self, moving into a more appealing products or services in uncertain time.
Thank you. Hello, tell me one thing, there are many activities which are increasing day by day and due diligence is an inseparable part of it. So can you throw some light?
Yeah, see, any kind of, and I'll probably maybe share a data point here from an M&A perspective. I think we've probably seen close to about 50 odd billion, 48 billion or 50 billion in the last half of 2021, purely on M&A, cross-border M&A in the fintech space. And so what that basically reflects that, the amount of interest that you were sharing and you were talking about, the interest that is growing in this space is huge. And a lot of venture capitalists and private equity investors are sort of very keenly looking at this, and then obviously become much more sort of realistic in their due diligence process also. So I use the word realistic. Why? Because if you were to go with a typical model for carrying out the due diligence for any such startup, none of those formulas would work. A typical financial formulas would not work in that. You probably have to sort of look at your price to earnings or and really understand the concept, the idea behind what is being presented to you, and if that is going to sustain for a period of, and what is the competition also. There's a lot of competition that is coming in every day, and there's a lot of transformation also and evolution by itself that is happening in that space almost every day. So you have to see whether this business is going to be able to sustain for not even going 7-8 years, whether it will sustain next year or 2 years from now, and whether it will be able to sort of give you the kind of the earnings and also risk reward is reasonable in that sense, and then that makes it easier for you.
Okay. Thank you. You want to add something?
Yeah, I've got some points here. I think what has been mentioned regarding the time taken to due diligence, it's very important because right now we see solo GPs and emerging fund managers are performing much more better than the bigger one. That's why Sequoia, for 4 or 5 months, they've announced us that they're going to be an evergreen fund, and then they're going to establish small funds which can make a decision within weeks rather than months. Because things are changing very, very rapidly. If you identify a startup today and then you take 6 months or 8 months to do due diligence and in order to put the money in the bank, that startup should not be at the same situation. If it is at the same situation, if it is at the same valuation, then there is something wrong. Yeah, you should have appreciated your capital a bit during these 6-7 months if it is really finding the right product to market fit, if it's really doing the right scaling. That's why we see a lot of emergence from or a lot of focus from top VCs into pre-seed and seed and into macro VCs funds which are like $5 million or $10 million or $15 million, which can make a decision probably within a couple of weeks.
Thank you. Pradeep, different people have different perspective, right? Some people think that COVID hit them hard and they are now not growing organizations or something. But some people believe that they are into growing sectors and COVID gives them an opportunity, right, to accelerate their business. So what's your take on this? I mean, did the pandemic help or it hampered the ecosystem?
Right. I believe that from the point of view of dealing with these problems and coming up with solutions, it basically completely, as Parin clearly mentioned, it depends on the founder's will to go through these times and how to execute the idea, be it a requirement to pivot from the existing business model. But if we are successfully able to steer it in these tough times, I think that will be good enough for a startup to grow and prosper. To give you an example, generally people, especially okay, I can just say about India for now because I have seen it firsthand. There is a problem of waste management in India. Government has also taken a lot of initiatives from their end to do the entire cleaning up of the country and cleaning up the streets, everything. But there was not many activities observed from the entrepreneurs on that front because the chances of making profits are very low. The profit margins are very low in this sector. Interesting point is that when COVID hit, people started working from home. The amount of waste generated out of these homes increased rapidly. People started doing deliveries of stuff, boxes, cartons, everything was on the street. And there were people, entrepreneurs who saw an opportunity on these things. And luckily enough, there are major companies around the world who, as part of their CSR initiatives, put in money for such causes to create a social impact. So these startups actually started poaching these investors and tried to solve these problems with a slow and low profit margin, but their success was mostly measured in terms of impact that they created. And I'm glad to see such companies grow because they are successfully raising funding and growing, solving problems like these which were not ignored completely but not taken up actively as well during pre-COVID era. But now they have been taking these problems very seriously. As Amardeep was mentioning, that private capital should also focus on areas where traditional factory workers are going out of work. I know that is a very concerning problem because every investor invests in the ventures where there's a certainty of certain amount of return. But there are certain ideas floating around in the market, and there are successful companies also who have proven it over time that they can actually take service from these out of work employees, give them some work and generate a product out of them. To give you an example, there's an e-commerce company in the country called, in India called Meesho, which kind of sources goods and materials created by women of Rajasthan who creates covers, iPad covers and iPhone covers which are sold in US for like multiple dollars. But their manufacturing cost is slightly less than $1 per piece. So Meesho is also a company which kind of showcases these products within the country for our citizens of India to buy it. Rather than going on Amazon and buying a branded product, they can find a similar product with the same quality, almost similar quality at a cheaper price. And thus helping the ecosystem of people who are kind of struggling in these times. So I know that the impact is not as high as it should be, but we are, pushing towards that direction. And to answer your question, I think with a little bit of negativity and a lot of positivity, that even though we are going through these times, private capital has a positive impact overall to cover the entire thing.
Thank you. So, I guess this was a very wonderful and healthy discussion. Yes or no? Yes. And private equity, of course, it's a bright shining star which has the capability to give light to distressed sectors and persons who are in hope to create better future for their ideas. I would conclude by saying, change will not come if we wait for some other person or some other time. We are the ones we have been waiting for. We are the change that we see. Thank you.
Amazing. Great job. Amazing. Thank you guys so much for your time. I'm going to open it up for some questions. How are we doing? Okay, we're getting close to the end here. We've had a great, amazing day. My friend with the smile over there.
I am Pankaj. I just have one question. How and at what level the resilience of private capital was tested during the COVID times?
Can you repeat the question?
I was asking how and at what level the resilience of private capital was tested during the COVID times.
See, it depends between how mature the market is
If you look at markets like US, for example, the VC investment has grown threefold. If you look at Africa as an emerging market, we see there's a lot of money moving to Africa because the preferences of investors, they tend to be more of a basic needs in terms of agri-tech, in terms of fintech, financial inclusion, and stuff like that. So it depends from a place to another. But I think we have seen it contributing a lot during the pandemic and post-pandemic. How continuous or resilient that could be, this will appear during the course of the coming months. But again, if the founders are sorting real challenges with the proper financial metrics, and it will still be appealing, and the money could still be flowing. Thank you.
Yeah, if I may add to this, I think you talked about resilience during this COVID period, and I think if we were to again use some data points here, up until March 2020 or just before the COVID really hit 2019, the size of the private equity investment in fintech space and startups, etc., that number actually came down very drastically in the first half of 2020, just like any other business, and it actually did. And then when the businesses started realizing the fact that digital transformation was the only journey that anybody could have, whether it talk about educate tech or fintech or insure tech, etc., and all of that. And then the second half of 2020, and we've seen growth since then. I don't think we've tested anything negative since then. There's only been the numbers have only sort of quadrupled, and the number of deals have also gone significantly increased since then.
Thank you.
Okay, thank you
I
for
can
that
actually
question.
add my experience to it. During the COVID, in fact, first lockdown, my startup funding happened over Zoom. I had not met any of my investors, right? So, and similarly, I think seen my friends' startups who actually were struggling when the new rounds did not happen. The existing investors stepped up and they have pumped in money so as to ensure that they are able to scale over the tide of the COVID pandemic. So they have been very supportive, I think that's the.
Wow, so lucky. That sounded like an incredible, ideal opportunity, right? To be able to still get investment when you're sitting on Zoom. So that's fantastic. Thanks for sharing that story. How about another question for this team, the panelists? Oh, yes.
So pretty common question, or you can say an extension of the question that Pankaj asked. Do you think the venture capitalists or private equity is moving too fast, too many? My question is, we're seeing the brighter side of things. We're seeing that businesses are solving problems. We're funding those businesses, or those businesses are getting the funding. But we're also, on the other side, if you actually look at the darker side of it, the fund values are eroding equally fast for certain companies because you are going back to the traditional way of doing things. EdTech, growing fast. Byju's, one of the biggest examples, one of the best examples, grew really fast over the last 2 years, but they've slowed down. Fintech. And let me not take the names, but I think everyone here, at least from India, we realize the negative side of fintech. At least the two largest fintech companies, we see how their fund values are eroding. Are they moving too fast into a public offering, and is that the primary reason for their fund value eroding, or are they exiting too fast?
I think yes, when it comes to the larger rounds of funding, people are taking much bigger bets, right? I don't want to make the investors negative about it. It's good for us founders like us. However, when it comes to larger rounds, yes, I see that the fund values are becoming much, much bigger, and they are not looking at the operational efficiencies. For example, in Walmart, we used to look at save money, live better. The kind of operational efficiency a Walmart store used to bring in, I have not seen that coming in the fintech, not in the fintech, I'm saying in any of the startups at scale, which become very, very important because at mature state, they are now becoming mature businesses. So hence the investment decision should have been on the real financial statements rather than the projected financial statements, right? So I agree, and however the larger fintechs that you are saying, the issue has been more rather than relating to the investment side, it has been more related to how the QR code, how the UPI changed the dynamics for them, etc. So that's a different story. But yes, I agree with your point. However, I hope that investors do not agree with my point and they continue to pull our direction.
If I would comment here, yeah, there are certain mature markets, the valuation has been really going maybe unrealistically high. But again, there are many investors who are looking for the secondary for the second market. I mean, there are many investors today in Africa, for example. They are avoiding, Nigeria, Kenya, Egypt, and South Africa because those are much mature markets and valuation tend to be higher. But it depends on the deal flow that the investors are getting through based on their thesis and their ability to manage the local component in those territories. So it's a balance. But again, the whole VC industry depends on risk mitigation. You've got few ventures that can make for you the whole return and the other that does not make. But generally, there is ample amount of cash available. End of the day, most of the investors, even the ones who are not tapped into VC and private equity, they know that keeping their money in their bank account will hurt their IRR, and eventually this money has to move. So it's the role of the founders, in order to bring really innovative ideas in markets which are not really inflated. There is some inflation evaluation in some of the market, and this will be subjected to some correction.
So we should focus on positive sides, then only it will be a positive outcome.
It does, but that's a food for thought for everyone. It's not a question, it's more of food for thought and how the investors look at the situation, right? Do we also need to provide enough support, like Amardeep pointed out, right? Do we need to provide enough support to these startups? Relatively inexperienced people, right? You're seeing people get into startups who are extremely young, who have a new idea, who've seen a problem in the industry, and they're trying to solve that problem. Techniques, do we need to, as an investors community, do we need to provide them operational support, operational excellence, or pump in, apart from money, pump in experience into their businesses? That's
Great point, and I appreciate that.
No, it's absolutely right, and I'll probably speak connected with on a slightly lighter note, and then maybe address the question that you had. I mean, it's all the most popular word that we used in the recent past is FOMO, right? Yeah, fear of missing out. So, and that is what is happening on both sides. It's happening with the young millennials who want to, who come up with this idea or a solution that they have, and they want to sell that idea and start and all millennials say, if I haven't started a startup, then there's something wrong, by the age of 24 or 25. On the other side, there are people who are sitting on cash and private equity and venture capitalists, etc. And they're saying, so far we've invested in traditional business models. If I haven't invested on this, there is something missing out because everybody else has made multiple IRRs, etc. and all of that. And that's where this whole journey begins for professionals and consultants who are going through all this education and trying to sort of, get them to do a proper due diligence on this and make sure that there's a good marriage at the end of the day.
Yeah, quick note on the operational support. as you could see, all there is an emergence of venture studios all over the region. I mean, in UAE, only over the last 1 year, there were more than 10 venture studios, whether they are abroad coming up to the region or they just emerging from the region. And those are specialized venture studios, like our venture studio specialized for mobility, logistics, and supply chain. This is what we know well over the last 15 years, and this is what we can. We could extend operational support between 12 to 18 months, making the founders focus on developing market and developing their product. They don't have to care a lot about the financial management, account keeping, legal, and all this stuff. This is an extension of the trend of accelerator incubators, which has been there for a couple of years, for 2-3 months. But again, this is much of a firm operational support in a corporate or running, BOCs with large corporate and having the whole corporate governance, which will also de-risk the investment and help the founders, maneuver through many other departments apart from their own core responsibility.
Thank you guys. I love this panel. You guys are really informative. Thank you so much. You are the leaders in changing this industry, letting the young people and seeing how they're developing this industry and how it's going to grow for the future. So you're impacting it a lot. Let's give them